As a Canadian investor, it's not often we see big headlines and dramatic arguments between different sides within the country over oil and gas investments. That's not usually what hits the headlines here in Canada. We're usually too busy either talking about politicians or talking about the Americans. But right now, there's this big story happening in the Canadian oil patch, and I think it's indicative of a much larger story that's been going on for the last year or so. Today, we're going to talk about the Strathcona Resources Meg Energy drama that's been going on since Strathcona tried to purchase Meg just about a few months ago now. We're going to talk about the process that's been made. We're going to talk about what Meg's board is saying and what Strathcona Resources are saying. Finally, I'm going to give a couple of my own thoughts to round out what I think this is telling us and where we Canadian investors can go from here. Welcome to Golden Arch Investing. My name is Liam. On this channel, we talk about investing in Canada. If that interests you at all, please do like the video and subscribe to the channel. We're going to start right here with the news that broke almost a week ago now, on the 16th of June. I'm filming this Sunday evening. You guys are probably seeing it Monday. And so 16th of June, about a week ago, Meg Energy's board recommends shareholders reject the Strathcona offer and, all caps, not tender their shares. The offer share consideration exposes shareholders to a company with inferior assets, they say. Selling by Waterous Energy Fund and its investors to provide liquidity will put downward pressure on the share price, they say. Meg is a uniquely attractive investment opportunity that warrants a premium valuation, and Meg has initiated a strategic review of alternatives with the potential to surface an offer superior to the company's compelling standalone plan. Now, when this headline broke last week, there was a bunch of subsequent headlines that followed, and one of them will be the second half of this video. But another interesting headline I saw was the idea that there was nobody else willing to take this deal. Now, let me be 100% clear. I am not an insider at Meg Energy or at Strathcona Resources or at any other Canadian oil firm, so I have no idea if anybody else is planning to make a deal to purchase Meg. But it was really interesting that we went from the narrative a couple months ago being, hey, there's all these other big players that might be interested, to nobody else is going to make a deal, they should take it now. Now, obviously, the board at Meg Energy does not like the Strathcona Resources deal. We've also heard a couple key investors, specifically Eric Nuttall. I mean, we've talked about him a couple times on the channel. He's one of the most outspoken Canadian energy investors out there. Dude does not like this deal for a couple of reasons, and he did a better job of explaining them, of course. But I think the key reason is simply that he thinks there's better value here at Meg than there would be combining them together. Now, I think it's definitely interesting. A lot of Meg shareholders have already exited the name. This is sort of the narrative going on among retail traders, sure, but mainly among institutional holders, where sort of the longer term traditional shareholder base have exited the name to a large degree on the big pop they saw on the news that there was this deal going out there. And a lot of arbitrage traders have stepped in. Now, what that means is there's a lot of people that are hoping to make a quick buck on the quick movement of the stock if somebody else comes in higher. Or the more likely scenario, I think, is that if Meg demands more money from Strathcona for this to come true. But still, let's read through exactly what the directors want their shareholders to know. This is from the Meg Energy website, so straight from the source. Calgary, Alberta, June 16, 2025. Meg Energy Corp, Meg or the company, announced today that its board of directors has determined the Strathcona Resources deal, the unsolicited bid to acquire all the issued and outstanding Meg shares, is inadequate, opportunistic, and capitals and underline and bold, not in the best interest of Meg or its shareholders. On May the 30th, Strathcona made a formal offer to acquire all the issued and outstanding Meg shares it does not already own for a combination of 0.2 of a Strathcona share and $4.10 in cash per Meg share. This is what they're calling the offer. The offer remains open until September the 15th, 2025. Meg's board formed a special committee to conduct a thorough evaluation of the offer with the assistance of financial and legal advisors. Following this review and on the recommendation of the special committee, the board has concluded that consideration to be received by shareholders under the offer is inadequate. So the payment to shareholders is what they're saying there. From a financial point of view, to shareholders, it's not in the best interest of the company or shareholders, and unanimously recommends that shareholders reject the offer by taking no action and not tender their shares or not sell their shares. Strathcona's offer is inadequate by all reasonable measures and is not the right path forward for Meg shareholders, says James McFarlane, chairman of the board. Combination with Strathcona would expose shareholders to inferior assets and significant capital market risks, including a $6 billion overhang resulting from Waterous Energy Fund's 51% ownership in the combined company, which would allow WEF investors to realize liquidity over time. So that's a big storyline we have seen some talk about. I mean, we've seen it even here. We're public market traders here. We're public market investors. We don't buy things on the private market at the retail, normal person investor level. So we don't really have access to things like these big funds. And obviously liquidity is huge. One of the main reasons why the American markets are so popular. There's just so much liquidity. Even small cap stocks trade millions of shares a day. Strathcona Resources, part of the challenge with that share and with the price of those shares and with owning that stock in general is that a large chunk of it is owned by the Waterous Energy Fund. And so the liquidity is low, which means price discovery or like the market valuing this is harder and probably a little bit less precise. Now that does mean there might be more opportunity at times when, you know, oil is out of fashion. Maybe now, we'll see. Maybe in the next 6 months, we'll see. Obviously, I think world events are probably impacting that. And again, you're going to see that probably better Monday morning than I do right now because the futures have not opened as I film this. But I'm thinking that that's been a big block for a lot of us public traders. A lot of the institutional traders that buy things on the TSX, you know, be a ETF fund manager, right? They're maybe staying away because that low liquidity presents risk. It definitely does. And here, Board of Meg is saying basically the same thing. The board today filed its director's circular, which provides information for shareholders about Meg's prospects and the board's analysis, deliberations, recommendations. The director's circular is available at the offer update on megenergy.com and on Cedar Plus at cedarplus.ca. Additional information can be found in the investor presentation, which is also available at megenergy.com/offer update. Meg has driven substantial transformation over the last few years, says Darlene Gates, Meg's chief executive officer. The strong balance sheet and low risk growth for a accretive facility expansion project, we're delivering sustainable shareholder returns. Our growing free cash flow supports a robust return of capital program, while our multi-year investment plan provides access to high quality resource and reduces per barrel costs and sustaining capital. You know what? All that sounds good, but look at the share price, right? And now, okay, I am a Canadian energy investor. I'm a Canadian investor more generally, but I own a lot of Canadian energy. I understand that it's not, you know, operational risk or operational failure that has caused share prices in Canadian energy to drop over the last 10 years. But if you're out, you know, you're out doing it, you're dropping worse than the industry, that might speak to some of these, you know, some of the struggles, some of the operational challenges that they faced. And, you know, some of that maybe is out of their control. Some of that's maybe like just the cost of doing business, the specific kinds of assets they own. But the counter argument to that would be, well, then why does everybody else want to own their assets, right? Why is it that Strathcona is stepping in and saying, hey, these heavy oil assets are so valuable if Meg's struggling? I don't know. Offer share consideration exposed shareholders to a company with inferior assets. They say Meg's asset portfolio is located in the heart of the Athabasca oil sands region, anchored by Christina Lake, a best-in-class SAGD, solvent-assisted, I'm going to forget what GD means, but basically a higher quality extraction style project with a top quartile assisted asset characteristics and approximately 5 billion barrels of discovered bitumen initially in place, supporting decades of low-risk attractive growth. This is the kind of asset we've been talking about on the channel. This is what we want to own. I think it's drainage, general drainage. Ugh, I'm gonna be so frustrated about the SAGD later. But still, together with an undeveloped resource at Surmount, May River, and Kirby, Meg is approximately 11 billion barrels of discovered bitumen initially in place. By contrast, Strathcona's assets are scattered, lack scale, and are located in less prolific areas with uncompetitive asset characteristics relative to Meg's Christina Lake. Now, of course, yes, as a Strathcona shareholder, they're going to say, hey, what? We have all these great assets, but you can't argue with the Athabasca oil sands. That is the premier asset right now in Canadian oil when you're looking at it from a longer term perspective. If you're of the opinion, like many of us investors, that you're investing for the sort of period of time between US shale starting to decline and wherever peak oil ends up being, you know, maybe you're in the camp that's in 10, 20, 30, 50 years. I don't know. Right. But obviously, if you're investing in these assets, you're looking for that time frame. That's when you're looking to invest for. You know, for me, that's maybe 10, 15 years. I'm looking to hold these assets. This kind of Christina Lake, Athabasca oil sands asset is best in class for that purpose and for that time frame. because it gives you this fantastic stay flat inventory where you can just produce at nice low cost once that initial barrier is sort of paid for. And, you survive the hard times and you flourish during the good times if you're disciplined with your capital, which of course not every company is, but Strathcona seems to be. So, maybe they'll do okay. But still, I understand why they're saying, hey, Christina Lake is best in class. Now, Strathcona's resources are still great, and we will let Strathcona respond in this video. We're going to go to what they say later. But, definitely, I've seen investors make this argument, including Eric Nuttall, who we talked about earlier. Next, selling by Waterous Energy Fund, WEF, and its investors to provide liquidity will put downward pressure on the share price. True. I will give them this one right away. WEF's concentrated 51% ownership position includes substantial and prolonged overhang risk, making the combined company a vehicle for WEF and its LP limited partner investors to sell their material ownership over time. Strathcona does not have sufficient trading liquidity for WEF and its LP investors to sell their interest in the market. Strathcona combines with MEG, WEF will have more liquidity to attempt to sell its $6 billion stake. This selling pressure, or even the perceived risk of such selling pressure, will place immediate and significant downward burden on the share price of the combined company for a prolonged period of time. I don't know if I agree with the sort of follow-up or the, if then, but the if is true. WEF has a huge stake in Strathcona. They have a controlling stake, 51%. Over time, it's logical they might want to sell that. Now, it's not 100% that they will sell that, and it's by no means 100% they're going to sell it anytime soon. But it makes sense that some of the partners are going to want to sell their shares. Now, the thing is, a lot of those investors who own part of the Waterous Energy Fund, who are invested in that, who even are just sort of like in favor of this deal, say that this deal is the solution to that problem. That Strathcona Resources stock, sure, has been held down by that challenge, but the greater company this will become will make that challenge far less, and it'll be less relevant than just the overall value of this business. Now, time will only tell, but I think there could be, and we will again let Strathcona respond to this, there could be some argument for why maybe Strathcona is going to avoid this challenge. Now, they also say Meg's board says the offer is inadequate, which has been another big complaint by a lot of shareholders, including people we talk to and people we talk about on the channel. Offer lacks real premium. Its advertised premium was opportunistically calculated at the best and highest implied premium based on Strathcona's relatively thin trading. Since the announcement of the offer, Meg shares have consistently traded above the implied value of the offer, indicating that the market believes it significantly undervalues Meg shares. In reality, the offer of 0.62 of a Strathcona share and $4 in cash per Meg share does not represent a premium, but a significant discount when measured over periods other than the single day on which Strathcona calculated the advertised premium. Challenging, hey? Now, there's a couple of things to say here. Obviously, this offer is made spring of 25. Not exactly a great time to be an oil investor. These are both, heavy Canadian oil companies, so they're both dramatically impacted by that. If you wanted to calculate the sort of value of this from a time when oil is higher, that could have a significant impact. They also mentioned specifically that Strathcona's relatively thin trading impacted the comparative values of Strathcona shares and Meg shares. I see all that. I think that is, the job of the boards of both of these companies to put their heads together and decide how to calculate this premium. But I don't know where it's going to go, obviously. And then finally, Meg Energy says there's other paths to superior value maximization, which is basically them saying, hey, whoa, we can do a better job ourselves. Don't you want us to run your money for you? And you know what? In fairness, lots of Meg shareholders still do. So the argument that Meg's board is making here is basically boiling down to three things. Number one, they don't think Strathcona's resources are adequate. They think, hey, we're higher quality, you're lower quality. Why would we want to combine these things? We want to keep our high quality over here. You keep your low quality over there. We're good. Two, they're saying the ownership structure of Strathcona is bad for our shareholders. So we don't want any part of that. And three, they're saying you're not paying enough for this. So I wanted to show you guys what Strathcona's board responded with later last week. And this was a big thing I was waiting for to start this video. So we see here June 19th. So, a couple of days later, Strathcona Resources responded to Meg's circular, right? And you remember that's what they called this. So, and it says here again, Calgary, Alberta, basically down the road. Strathcona Resources today responded to the June 16th Director's Circular filed by the Board of Directors of Meg Energy Corp. in response to the offer by Strathcona to acquire all the issued and outstanding common shares of Meg, not already owned by Strathcona, as set out in the offer to purchase and bid circular dated May the 30th. So, what is it that Strathcona is going to say? Well, we want to see how they respond to those three pieces of criticism, but also what else? What are they offering to the shareholders of Meg, but also just the general investing public, the people who have this combined company in their investable world? What is it about this deal that makes it valuable enough that it should happen? Let's see. Adam Watrous, executive chairman of Strathcona, said Strathcona is delighted that the Meg board has accepted Strathcona's recommendation to initiate a strategic alternatives process for the business and fully supports them contacting other potential acquirers to determine if a superior transaction to Strathcona's offer is available. As Meg's second largest shareholder, Strathcona welcomes the Meg board's effort to market test the offer against other acquisition proposals and agree that the Meg board has a duty to fully investigate each proposal for the business, including the offer, which is what Strathcona is calling their own deal. So right away, they're basically saying, hey, we're a shareholder. We're the second biggest shareholder. Of course, we support you looking at the best way to bring value to shareholders. And I wonder if that's in there as a kind of like a little bit of a jab at the board of directors of Meg Energy. I don't know, right? It depends. It's hard to read into the tone of something written, but to me, and this could just be me putting my own spin on this, that sounds like them saying, yeah, we're glad you're finally going to get value for our shares we own. I don't know exactly, but that's just kind of how it sounds. Strathcona looks forward to engaging with the Meg board. As stated in Strathcona's May 15th, 2025 press release, Strathcona remains ready and willing to participate in the Meg strategic alternatives process and looks forward to engaging constructively and in good faith with the Meg board. As a starting point for this engagement, earlier today, Strathcona posted a new presentation on its website titled Meg Director Circular, Fact versus Fiction, which corrects a variety of errors and misleading statements in the Director's Circular, with Meg and Strathcona shareholders are encouraged to review. Adam Watrous added, Strathcona looks forward to participating in the strategic alternatives process, which will also provide an opportunity for Meg's board to learn more about Strathcona, something which it has declined to do to date. Think about that statement right there for a second. Not only do they have a fact versus fiction sheet, which is, again, definitely there's some, like, I'm a teacher, right? So I read when kids try to write something sarcastic. This kind of feels like when a kid's trying to be, a little bit sarcastic in their writing, right? They have a fact versus fiction statement, right? They have declined to learn about Strathcona to date. They're basically saying, hey, you don't understand this. You don't get it. You don't get what we bring to offer. You don't understand us. You don't know me. I think that's really interesting. To give the Meg board a head start in understanding our business, we have corrected a variety of inaccuracies contained in their circular. Ugh. Again, when does this happen in the Canadian oil patch, where you get these two companies like butting heads publicly? They're calling each other out on the internet. Crazy. Strathcona's offer remains compelling for both Meg and Strathcona's shareholders. Strathcona firmly believes its offer provides a true win-win for Meg and Strathcona shareholders, uniting two heavy oil pure plays into a new Canadian oil champion while delivering significant accretion to Meg and Strathcona shareholders on all key metrics. Pro forma business would be uniquely positioned in the capital markets as the only 100% oil company in North America with an investment-grade balance sheet, 50-year reserve life index, and no exposure to mines or refineries. While Strathcona agrees with Meg's statement in its director's circular, other peer companies could also realize significant synergies from such a transaction. Strathcona believes it is the only peer company which would be able to, upon completion of the transaction, 1. Obtain an immediate investment-grade credit rating upgrade. 2. Immediately join all major Canadian oil and gas stock indexes due to its larger float. There you go. 3. Credibly execute on meaningful overhead synergies as evidenced by Strathcona's existing best-in-class overhead costs. So, okay, look at what they're actually saying there. So the credit rating thing, kind of different. That's more of like an operational thing versus like a shareholder related thing. But then look at number 2. Immediately join all major Canadian oil and gas stock indexes due to its larger float. One of the big problems Meg had pointed out was that Strathcona doesn't trade enough and that them selling is going to put long-term negative pressure on the stock. Well, if all of a sudden they're in, yeah, let's say an XEG, for example, a TSX oil and gas index that is owned by major mutual funds, by, pension funds, by like big money. I'm talking real big money. Well, that's an immediate counterbalance. And if you don't see Strathcona shareholders and specifically Waterous Energy Fund shareholders selling out quickly, you could actually see that put positive pressure on the stock. So that immediately fights that second argument of the ownership structure of Strathcona being a huge detriment. 3, them saying, hey, you think there are better ways to get around this. You don't think we operate well enough. You don't think we have the assets. Well, they're saying that they have best in class overhead costs, and that would sort of get rid of that challenge. And also, I guess the operational value of having this increased credit rating, that could put an argument against we don't have the good enough assets thing, because now they can invest more based on this credit rating at a cheaper price. Offer information. Strathcona's offer provides that each shareholder with whose MEG shares are taken up in the offer will be entitled to receive 0.62 of a common share in the capital of Strathcona plus $4.10 per MEG share in cash. We open for acceptance until 5 p.m. Mountain Time on Monday, September the 15th. Shareholders who have questions or require assistance in depositing MEG shares to the offer should contact the information agent, Laurel Hill Advisor Group, by email. One thing I will say there, them making sure this is as publicly available as possible, because think about it, them writing this down in paper here, I'm sure it is also written down on their website and in other places, but every time they put it out there, each Google search for, Strathcona Resources Meg offer is going to pull more of this information. And so those arbitrage traders that we had talked about, and big investors have talked about this, those arbitrage traders are moving into those MEG shares. Well, they will suddenly be able to gain access to that information. And if that MEG share price just drops just enough for this to be valuable, you better bet those traders looking to scalp that little bit of profit are going to grab these shares here, deposit them there, right? If market price drops enough to where this share offer presents value, like it or not, there's going to be shares moving. Eventually, Strathcona is going to hold more and more of the float. And then here's the challenge. They own more and more of the float. There's pressure on the stock and there's lower liquidity. You could see more and more, decrease in price, to be honest with you, to just be completely honest, because all of a sudden you're trading less, liquidity is going down. It's harder to have a price equilibrium. And if people start offering the amount of money it would take for them to make money off this deal, could be an interesting challenge. Of course, market dynamics are complicated. So I don't know if they would be able to get enough MEG shares to make this happen, but it would only take 51% for them to suddenly decide to flip the board and take the offer, right? To flip the board and push out those who are not in favor. So then they offer a couple additional things. They say basically who they are. They give additional sort of information. They talk about their legals. But here's what I think is going to happen. Okay, let me just sort of play out how I think the scenario is going to go. Depending on the macro trends in the oil and gas market, we're either going to see one of two things. One, another player comes along and is like, hey, we're in, we're willing to do this. Or two, you see the slow motion process of Strathcona accumulating shares. Now, this could look like Strathcona revising this offer in a bullish oil market to be like, hey, we understand that maybe the events that are going on in the Middle East or what else has increased the oil price, and therefore we understand that Meg Energy's assets are worth more right now, and we're going to pay more for them. So, I'm obviously paraphrasing, but they could give another statement along those lines, suddenly increase the amount of cash, right? They have to increase it by a couple of dollars, or even just $1, and then suddenly you have, again, a huge flood of arbitrage traders willing to step in. This could also, in a sort of more negative oil market, if you see, OPEC raise, supply again, or some sort of big U.S. Economic data point that sucks, right? Like a negative GDP print that calls it an official recession in the U.S. And then, stuff like that has materially impacted the oil price. If that happens, you could see then the MEG share prices start to drop. And as soon as they drop, again, like we talked about, with the lower liquidity as Strathcona picks up shares, you're going to get arbitrage traders who step in and start being like, oh, scoop them up, give them to Strathcona. Scoop them up, given to Strathcona, could be a big deal. We don't know for sure. But I think there's gonna be some action here. Meg doesn't seem like it's staying independent. And I guess that speaks to the greater question right now. How many Canadian oil and gas stocks are there gonna be when it's all said and done? In the next 5 years, I think we could be down to single digits. And that's, maybe specifically in the sort of E&P space. But I mean, look at the amount of money flooding into this space. We saw a recent article on, I think it was BNN Bloomberg, but it could have been CNBC, talking about Canadian banks and the amount of financing that's gone into this space. It's actually increased dramatically. You've seen a general shift among the financial class, among the big players in the space, towards acquiring these assets, towards financing deals, towards being a part of these M&As. And this M&A cycle has just been growing and growing. This is the most recent deal, sure. But what's next? I saw an interview by Cole Smead. He was on Amber Kenmore's podcast. Great podcast. I'd recommend you check it out. I love to see as many, independent Canadian investment creators out there as possible. I'd love to see this community growing. But he was on that podcast and he was talking about what he thinks is going to happen next. And I think he called it a Synovus. He thinks might be the next player bought out. He thinks it might be bought out by Suncor. He talked about some specific market dynamics that might make that happen. And, we'll cover that when we get there. But I think there's more deals that might come. And I'm far from the only one. I published a video the other day talking about why there was so much opportunity to invest in Canadian oil and gas right now. And some of the commenters were pointing out, hey, I like this stock. I think it's going to get bought out. And I think there's short-term opportunity there where you could step in, take a position, maybe not a huge one, but take a position, and you could be rewarded tens of % in weeks, months, which if you can do that and replicate it, obviously is fantastic compounded over time. Now, I'm not a short-term trader. That's not my expertise. That's not what I do. That's not what I know. There are other people out there far better at that space than I. But I think we should keep our eyes on it. As long-term investors, our options are going to get smaller and smaller. Now, that's one of the reasons why I own one of the biggest acquirers in the Canadian oil and gas space. I own a big portion of my portfolio in Canadian natural resources. I own it in the public portfolio, in the large fund. I own it in my private portfolio, in my, my TFSAs and my RRSPs. And it's a fantastic stock for many reasons. But one of the big ones is that it's sticking around. And I don't know how many stocks we can say that for anymore. And that's a really interesting dynamic for us as public market investors who are going to see our options dwindle. Now, could that bring premium in the short term? Yeah. Could that mean that the options left start to be valued a little bit more richly? Maybe. But it's an interesting trend, and I'm really interested to see where it goes. So those are my thoughts on the Meg Energy Strathcona Resources drama, the bickering that's going on in the public space. What I think is going to play out, why I think it's going the way it is, and honestly, what I think is going to happen to Meg Energy. I think it's going to get bought. If it's not Strathcona, it's going to be because somebody else swoops in with a sweetheart deal. Let me know what your thoughts are in the comments down below. I'd love to see if you agree with me, if you disagree, if if you think it's getting bought, you think it's not getting bought. Love to see your thoughts in the comments. And of course, as always, if you enjoyed this video, please do like it. If you like this kind of content, subscribe to the channel, and I hope I see you in our next video.